Hello, my name is Paul Hopkins and I'm the Director of Acquisitions at CPI Capital. And in this video, I'm doing a quick overview of the underwriting for our new acquisition called Apollo Oaks in San Antonio, Texas. So I do have a much deeper, in-depth underwriting video that I created, which is about an hour long, that dives deep into the overall underwriting, the analysis, how everything kind of works, and how I built the sheet. So I built the sheet basically from scratch because there was no model that really fit the business plan that we have for this deal. So created everything from scratch. But I'll run through it here with you. So we are developing Apollo Oaks, which is 7 acres of land. You can see the plot of land here in purple, which we're going to be developing into. There's 30 lots that we're building duplexes on. So there's 60 units in total. Each unit is about 1,400 square foot finished. So that's 2,800 square feet total. You'll see up here at the top the investor return, so 28% IRR, 50% ROI, 27% averaged annualized ROI, and a 1.51 equity multiple. The development timeline is about 1.8 years. And we are starting off basically with buying the land coming up March 30th. And then we have a permitting timeline of 4 months. So normally permitting is about 7 to 8 months, but we've already engaged the civil engineer back in early January. And so by doing that, it knocked off already 3 months off of our schedule. So we've been able to reduce that down to 4 months. So from March 31st to July 31st. And then from there, we're going to start our horizontal construction, which is going to take about 4 months. And that's from July 31st to November 30th. And then we've broken down the vertical construction into 2 phases. So each phase is going to be 15 lots total. And each phase construction timeline is 6 months. So once phase 1 is done, then we'll start phase 2. And then once the business plan here is, like I said, to sell off the individual duplexes when they're completed. And the great thing about this deal is that all the units should be pre-sold by the time before we even finish construction. So everything's going to be pre-sold, and then once we have the certificate of occupancy at construction, at the completion of construction, then that's when we can transfer the sale to the end buyer. But what I have included here is an additional 2 months per phase to sell off those additional lots or duplexes. So 20 months of construction time plus another 2 months for each phase, and that's basically starting off in May 31st all the way to January 31st. And you can see I got basically a more of a detailed timeline here that shows the Gantt chart of how we're building this. So permitting timeline 4 months. Once permitting is done, we'll start the horizontal construction over the next 4 months. And once all the infrastructure is in, then we'll start phase 1 vertical over 6 months. And then once phase 1 is done, then we could start selling off the units. Once phase 1 is done, we'll also start phase 2. Phase 2 will start May 26th, going to November of 2026. And then when phase 2 is complete, then we could start to sell phase 2, ending January 2027. Okay. The sale analysis that we're using, the development cost per lot or duplex is $240,000. I've increased that from $235,000. Our development partner, Invest5S, has a long track record of developing these types of units, and they've nailed down the costs on basically every duplex and all the horizontal construction. But for the cost of each duplex, they've been able to achieve $235,000 per duplex, and I've increased it a little bit just to account for any inflation. The sales price per lot or duplex. I'm assuming 625,000, even though we have sale comps for an exact model, and basically it's a 27 unit or 27 lot development project developed by our same partner, Invest5S, at a location that's about 20 minutes away further away from downtown San Antonio, and they're selling for $650,000. So I've actually decreased it to 625. We could sell these for 650, but to add a little bit more cushion, I've used 625,000. Sale costs at the when we're selling the individual units, it's normally 6%, but we've also added on a disposition fee of 2% for each lot sale. And then we're also including a rate buy down for the end buyer to make it basically more attractive as a cash flow asset. So this rate buy down is, money that we have set aside, that it's in our analysis, that is going to pay for the end buyer's rate buy down, taking it from about 6% to maybe around 3.75 to 4.5, somewhere in that range. And it's all dependent on the end buyer's pre-qualification. But if the end buyer doesn't want to have a rate buy down, we could also use that money for any concessions to the seller, to the buyer. Okay, so I've also added in here a list of fees. So we have a 2% acquisition fee, which comes out to $245,000. 5% of the development costs comes out to $452,000. Loan guarantor fee, 2% of the loan amount, which comes out to $187,000. An asset management fee, which is 2% of the total development costs of $180,000, and a disposition fee, which I explained earlier, 2% of all sales price is going back into our sponsor fee bucket, which it equals to $375,000. So total fees back to the general to the sponsorship team is $1.4 million. We are needing to raise $3.4 million, and even though it says 100% is coming from the limited partner, the general partnership is actually putting money in towards this deal, and it's not treated any differently. That's what this calculation is doing, is if we were to treat the GP equity a little bit differently, but we're not. We're treating it the same as common equity. So $3.4 million is the total equity we need to raise. We've structured it as a 12% preferred rate of return. And then as we get up to after 12% pref and the investor principal has been paid back, we're going to split the profits 50-50. As soon as we hit 25% IRR to the limited partners, we're then now going to split it 30% to the limited partner, 70% to the general partner. So this makes it more enticing for the general partner to really push on getting the higher returns than it puts basically more of the fees and promote back into the general partner bucket. So as far as land acquisitions and fees, so I just explained all the acquisition fees. They're all listed right here. The land, we're buying it for $1.5 million. And right now we've got an additional cash reserve set aside just in case of any other expense that we didn't account for, and then additional closing costs of $170,000, which includes legal costs, additional accounting costs, marketing costs, title, and everything else rolled up into that. So $3.2 million, this is all the equity that we need to raise up front from our investors. And now as far as the soft costs being like engineering fees, other permitting, property taxes, that equates to $589,000. And this is going to be financed, and I'll show you the financing section down below. Okay, so $589,000 in soft costs. For the horizontal construction, we have $1.2 million estimated for that. And then for the vertical construction, we have $7.2 million. All right, so total project cost before debt, $12.2 million. Now, as far as the debt, The land debt acquisition and acquisition is 0% leverage. We're paying that all with cash, and we're using the land as collateral for the rest of the financing. Now, as far as the soft costs, hard costs for the horizontal and hard costs for the vertical, it's all this pretty much the same. It's 100% loan to value or loan to cost at 10% interest and an interest fee or financing fee of 2.25. So we've already been quoted at 2%, and I've increased it another 25 basis points to be a little bit more conservative in case there's any changes to the financing. So as far as the interest is going to accumulate over the life of the loan. So as we do these construction draws, that's when the loan balance will increase based on the need of construction, and the interest is then calculated on that draw amount, but then it's accumulated towards the end and paid from the sales of the lots. So the total construction interest equals $321,000. That's basically the 10% interest. And then financing fees of $200,000. That's the 2.25% that I show here. That's equity that we need upfront to pay our lender. So total carry cost of $524, all in construction costs of $12.77 million. So breaking down the sources of capital, equity at 27% and debt coming in at 73%, or $3.4 million of equity and 9.3 of debt. And if we break the equity and debt down a little bit further, we are $3.2 million in initial equity, and then additional $200,000 for our financing fees. And for the debt, it's the construction debt of $9 million, and then the interest reserves of $321,000. When we go to sell sell the lots at the end of the day, I've got it shown here that each lot is selling for $625,000. So for all 30 lots, 18.75. So basically the all-in cost of 12.7, and then our gross sale proceeds is 18.7 million. Minus the sales cost, so that includes our disposition fee of 2%, but also like the broker fee and other fees that equate up to 8%, so that's 1.5 million. And then the title transfer, as I was explaining earlier, and the rate buy down, 7.5% that we've allocated, which is $1.4 million that we would basically, it's in a reserve bucket in our underwriting that we would pay for that rate buy down for that end buyer. So 18.75 minus the 2.9 comes out to the net proceeds from lot sales of 15.8 million. So I've got a basically a waterfall of how all that all works, but just quickly showing you that these lots, they start to sell in month 15 here. So once the precedence of the flow of capital when we sell these lots is, first it goes to pay down the construction debt plus the accumulated interest, and then from there it starts to pay down the pref of the investors, then the principal, and then after that has been caught up, that's when we split the profits 50-50. So in my waterfall analysis here, just go up to investor here, and they will start to see their first cash coming from the lot sales in month 17. So month 17, if you go back, month 15 is when we start to sell these lots. But month 15, 16, and by month 17, we've paid basically our construction debt, or at least a lot of it. And I got it all broken down up here. But we paid off our construction debt. We have some balance to pay back to the investors of $975. But then we are still accruing more construction debt because we're still working on phase 2. And then by month 21, we're able to pay back the investors starting in month 21 and finish the project basically in month 23 in January of 2027. So I also have sensitivity analysis here. If permitting, the permitting timeline takes longer, our basis is at 4 months of permitting and our sales price at 625. So the investor IRR is at 28% here. This is the investor level IRR at 4 months permitting and 625. If we were actually selling these at 650 and still keeping at the 4 months of permitting, it goes from 28% to 31% IRR. Now, as far as the building costs, keeping the same at 625 basis and $240,000 construction costs, 28% IRR. But if we were to sell these for $650,000, it goes from 28% to 31% IRR. So that's a quick overview of the underwriting. Like I said, I have a much longer, in-depth video that goes into more details. So please let me know if you have any questions, and happy to answer them for you. Okay, thanks.